meant to be a conversation. You all asking questions because oftentimes we get, outstanding leaders come, give a plenary talk, and our general entrepreneurs never have a chance to ask a few questions. So what we wanted to do is make this very interactive. You cannot be shy here. You have to open up. No question is off bounds, but Pramod has the prerogative not to answer.
Okay.
So, please, put up your hands. I'll just start with one question myself is, in entrepreneurs you've invested in India, is there a set of common traits that you have found among the ones that have been successful for you?
See, my sample size is pretty low.
Is the mic on?
Yeah, can you hear me? Yeah. My sample size is pretty low, small, right? And it's spread across multiple sectors, so it's a little different, right? So it was when I invested, the company already had, if I recall, it's about 35 million in revenue. It was profitable, right? So it was more of a growth capital that we provided them. I was on the board for, about 5-6 years. And then the company went public in 2009, 2010, actually. Yeah, it's a public company now, doing very well, right, as you know. So, different stage, different focus. I'm on the board and chairman of Yatra, which I think some of you are familiar with, Yatra, which is a travel portal, right? Different domain altogether, right? We actually incubated the company and then recruited Dhruv and his team. There was a couple of guys that we moved actually from the UK to back to Delhi. And then I'm involved with a company down in Chennai called Sulekha. Some of you might be familiar with that. Sulekha was actually started in Austin, Texas, of all places. And
reverse hybrid.
Yeah, it's a reverse hybrid. Think about it. They had actually launched their service in Texas among NRI, non-resident Indians, and had started to think about coming to India. And that's when we got involved with them and raised capital. Company doing very well. And run very differently, right? Run in the sense that 30 plus million in revenue and profitable, which is hard to believe when you think of companies like Quicker. We're also investors in Quicker, and you look at some of these other companies growing obviously faster and losing millions and millions. So different models. So the entrepreneurs.
How do you feel about that? Losing money at scale, and then as you scale up, you lose more.
Yeah, well, so what's happening is, so here's what's going on, because I would say to a very large extent, it's driven by what's happening in the U.S. as well, right? So
and Alibaba maybe.
and to some extent Alibaba, but Alibaba comes later, right? See what's happening in the U.S. is, and I have a lot of companies. We're a large fund in the U.S., as you know. Lots of different companies, lots of different spaces, and been there for many years doing this. And what's happened is that in the public market, right? What has happened is that a lot of money in the U.S. That used to be in Europe, used to be in Brazil, even for a period of time in China and India, had gone back to the U.S., right? And the reason for that was that you saw what happened in Europe, and still happening, right? Negative growth, so to speak. Everything is in a recession. You look at Germany, even Germany, very modest growth at best, if any. You look at other countries, negative growth, right? And for a long time, a lot of companies, even big companies, you look at companies like IBM, right? Quarter-to-quarter decline in revenue, increase in profits because they're trimming, work staff and so on. Same thing with, HPs and, large companies. And so the street was very enamored with growth, right? And I have heard this firsthand from Wall Street investors, right? Talking about not banks, but investors, mutual funds, right? They're all looking for growth, right? And so the mantra about a year ago, and I won't name any bankers and I won't name any investors, public market investors, or hedge funds or anything of that sort, but the mantra was simple: growth at any cost, right? A year, losing lots of money, right? But the street loves it, right? Because what they're saying is that, listen, it takes money, you have to spend money to make money, right? And when a lot of companies in the marketplace in the enterprises are declining in revenue, and here's a company that's growing 100% a year, right, in revenue, we want to be in this company, and we know that you're going to be losing money for a period of time because you are buying market share, you're making all the right investments. So that's the mantra in the US.
So I can't resist one more question before I open it up to the audience. So Bezos has been selling that story for a long time, right?
Yeah.
And we have our own version of it happening in our market
Yeah,
as
yeah,
well.
yeah, yeah,
What's
yeah.
your point of view on that? Because those have been eye-popping numbers for all practical purposes.
Yeah, and I think that'll continue for a while. Sectors come in and out of favor. What you've seen in the market, for example, just back, if you go back 6 months, right? And in the month of March, April, in the US, there was a big market correction, not in the market itself, but among what's called momentum stocks, right? A lot of momentum stocks were growing very rapidly, right? And the prices had gone just sky roof, right? And then all of a sudden the market corrected, right? Or those stocks corrected, pardon me. The companies are still spending money, and they're still losing money, growing as much, but today the market is not valuing them at the same multiple that they were back in March, right? Yeah, the growth premium is contracted. Now what the street is saying is the following, and I've heard this directly from public market investors in the US, I'm talking about the US, and that is, hey guys, growth is very important, right? But what you have to do is show me that as you are growing, you have operating leverage. So they say, what does that mean? Help me understand that, right? So this is what the street means. This is what the street looks for. And I think entrepreneurs here, as your companies get larger, now this doesn't apply when you're a small company, but as you get larger, it applies. What they're looking for is operating leverage is defined as follows. All right, you're growing rapidly 100% a year, and you're losing money. Okay, we understand that, but show me that quarter to quarter and year to year, but actually quarter to quarter, more granular, show me that your cost of sales as a percentage of revenue, your cost of operations as a percentage of revenue, your G&A as a percentage of revenue, your marketing and sales cost as a percentage of revenue, that the slope is coming down, right? That's called operating leverage, right? So, in other words, you're becoming more efficient.
Eventually
right?
you break even.
So then they say, we see the trend line, it's going the right way, and then what they do is they look at it and they say, okay, if this trend continues as is, how much cash are you going to burn through? And do you have enough of that on your balance sheet? If you've got enough of that on your balance sheet, and if your trend line's going like this, the street's very happy.
Okay, cool. Let's open it up. Yeah, go ahead. Be very brief, but introduce yourself and ask a quick question.
Anand from Ivan, I'll continue with what Ravi asked. Now, a lot of the companies are sitting on cash in India and globally and still raising revenue. So, what is your, talk about the entrepreneurs? They're losing, they're kind of giving their stake fast. Is it a good thing? And why should they raise cash when they already, are sitting on a lot of cash in hand?
Well, I think, okay, so again, I don't know which company you're referring to, and, but essentially, one of the things that you have to keep in mind is that, for a company that's losing money, you don't want to wait till a month before you're going to be out of cash to go out and raise more cash. So a lot of these companies are raising cash for a variety of reasons, right? They are losing money, right? So they know they're going to need cash, even though they have a big balance sheet, but they realize that, they probably realize a couple of things, right? One is, hey, cost of capital is cheap right now, so I might as well get it now, right? Number one. Number two, I might need that capital to fund my losses, but I might also use that capital to do some acquisitions, right?
So you would, for early stage entrepreneurs here who are thinking, hey, it's bubbly, is it, and maybe they've done a round, or a small A round or something, and should they be actively raising aggressively at this point? Maybe the window is shut suddenly, right?
Yes, that's the other thing. That's the other thing that entrepreneurs have to worry about. I went through this with a lot of my companies back in 99, 2000, right? See, cycles come and cycles go, right? Nothing ever stays the same. You all know that, right? We've seen that. And so, entrepreneurs, can be sometimes overly sensitive about dilution, right? And, if you've seen these cycles, hey, listen, if the cycle is in your favor right now, if you are making progress on your investment, in your company, you think you're going to need capital next year, don't wait till the last minute to raise capital, because if the cycle shuts for some reason, valuations are going to collapse, and all of a sudden it's going to become more expensive, more dilutive to raise money next year. Now, obviously, you don't want to raise money 2 years before you need it, but it's not uncommon for companies to raise money 6-7 months before they're going to run out of cash, because the concern is what's going to happen to the cycle.
And you suck the wind out a little bit
Yeah.
for your sector too,
Yeah,
right?
yeah.
Maybe 2-3 guys, horses who get funded.
Yeah.
You have the fourth in trouble. Yeah, go ahead. Go ahead.
Yeah.
Wherever the mic is, we'll go.
Sorry, grab that.
And please circulate the mic. Okay?
This is Dipanjan. My company is A2Z Apps. We're a cloud OS company. One of the guys that came back from US to build my IP in India. The question here is for me, we had another speaker yesterday who's talked about building a hammer and then finding multiple nails to kind of hit it on, which basically means, finding multiple problems to solve, I guess. And I think we have, my company, and obviously everyone has their personal perspective. I think we have found that when we see multiple revenue streams coming from different areas. Now what happens is when the few times that we have spoken with the VC community, the question that comes back to me is that you need to focus on one. And I'm talking from the perspective that we have good revenue stream coming from multiple problems that we're solving. Now, how does this match with what you mentioned in the fireside about being a feature
Correct.
or a company?
All right, so all entrepreneurs are always faced with optionality of being able to do many things. But at the same time, when you go to the investor, they say, no, you're just too confusing. I don't know what the messaging is, what you're actually trying to achieve. What is it you do, right? And you pick one of these and come back and pitch me. But maybe, you pick that one, and then when you go pitch them, they're not interested still.
Yeah, so I think the issue really becomes, again, I don't know the circumstances or the details, but, having faced similar kinds of issues, in other companies, more of them in the US than anywhere else, you don't want to tackle 5 problems at the same time. See, or 5 verticals at the same time for that matter, right? Because, when you're small, now, it's a different story when you're a large company, right? In fact, if anything, a lot of companies fail because they're too narrowly focused, right? I'm talking about large companies, right? But I think in the initial days, you have to have a certain element of focus, right? Now, that focus doesn't mean that you don't go after multiple verticals, right? Because sometimes you end up with with an app or which is more of a platform, and it goes across multiple verticals, right? Now, what you have to do though is make sure that let's say you tackle the first vertical, whatever it is. What you don't want to do is spread yourself so thin that even in that first vertical, you're not doing enough justice. In other words, customers are complaining, or your salespeople cannot go to all the customers that are possible in that vertical because features are missing and resources are not there. So you have to be careful. It gets down to sort of making sure that your resources are well matched to solve. Now again, if you've got a fair amount of capital, and there might be one reason to raise more capital, so you can go after multiple verticals. But I think focus is very important, though.
I'm Anil Kumar, representing a company called Ideas Luminous. As an investor, how do you rate a company that's technically very strong but poor in numbers to bring investors to the table? What should company be doing to impress investors? I mean, how do you judge?
How much traction do you need to see before you're willing to pull the trigger?
Yeah, there's really no one answer. I mean, there's a lot of variables. As I mentioned, in the brief conversation earlier, I mean, one has to look at, what is the background of the founders, right? And the people in the company, right? Do they have the right domain experience, right? Do they have, additional team members that have the right level of domain experience, for whatever vertical you're going after. If growth is not there, then the question becomes, what's wrong, right? Because, if growth is not there, if customers aren't buying, then something is wrong. You have to diagnose that, look into it and say, okay, something is not working, right? Because, investors are not going to sort of throw money, right? That goes back into that whole issue of, if some reason growth is stalled, then that raises the question, is this a niche? It's a small niche that you're going after. Is this a Me Too product? Is this a feature versus a company, right? I mean, one of the challenges, let me give you an example, or a word of caution here. Back in, sort of, I'm going back somewhat in time, but I think there are some similarities in the time frame. Back in '99, right? Vinod Khosla, and I'm sure a lot of you are familiar with Vinod Khosla. Vinod Khosla and I had funded a company. It was in the networking space, right? It was in the wide area networking space, a company called Fiberlane, a fellow by the name of Raj Singh. Some of you might even know Raj Singh. Raj Singh had actually started the company, and then Vinod funded him, did the Series A. I came in and did the Series B, and then we stayed with the company for a long time. Eventually, company took off, did very well. We had to make some changes. We had to bring in a new CEO and so on and so forth. Raj was the original CEO, then we had a different CEO, and then we had to scale the company, bring in another guy, Carl Russo. And then we were getting ready, company was growing rapidly, we were getting ready to go public, right? Time frame now is 98, 99. Those were the heydays, right? 99, I think. And Cisco came and paid close to $15 billion back then to buy the company, right? And we were very happy to sell the company, right? We had no doubts at all. Norwest, my investment, we made $1.5 billion in gains, right? Just on that one investment. Okay. Now, let me tell you what happened. Right after that, right, and this is what I mean by Me Too. Right after that, right, about 50 companies in the United States of America got funded by venture capitalists to go after that same space. Now, tell me, is there any logic behind that? 50 companies get started to do the same thing that Cerent was doing. Fiberlane split into two companies, Cerent, which we sold to Cisco, and then Sierra, which we sold to Redback, right? 50 companies get started doing the same thing. And limited set of customers, you're not talking about consumers, you're selling to carriers, right? AT&T, Verizon, CenturyLink, and there were like about 10 others, and that's it. And then you have global carriers. That's it, 100 customers worldwide, that's all. 50 companies. Now, that is sometimes happens, right, where when euphoria is there, founders get carried away, investors get carried away, and so much money gets thrown in, and then guess what happened? 2000 came, right? .com crash, a lot of investors went out of business, and one by one, over the next 4 years, all 50 of those companies disappeared, literally gone. And hundreds of millions of dollars was thrown down the drain. So I think that is where, one has to be careful about, you don't want to be a Me Too company, right? One of the rules that we use within our shop is, if we see a sector, right, or a trend in a sector or an investment theme, and if we are the number 3rd or 4th in a sector, we say no, doesn't make sense, right? You've got to be at least either the number 1 or the number 2 or the number 3. Beyond that, too hard.
So, entrepreneurs can also fall ill with the herd mentality thing. No?
It's
often accused of investors.
No, same thing with because it starts, in fact, before the investors.
Right, because that's
someone builds
the way
something.
it starts.
Right?
Absolutely.
So I think one has to be very careful about that. Yeah.
Right. Go ahead.
Good afternoon. I'm Raghav Kumaria. My situation as an entrepreneur is slightly different and might not be applicable for most of them. I'm an employee of a company called Tech Mahindra. Within that setup, in that capacity, the board has invested some money in my concept. A classic case of where I had a concept to go to market, and we run this as a company within company. So I run this as a concept as a company. So board is a VC here. Now, I'm standing at a point in inflection where the first phase of investment that went into, the market is going up, and I have a product, and now I have leads, and I have some customers going in. But I need more money into the same product. But the ROIs of the last investment has not come in. So when I go to the board next,
When you
what
say
I want to,
what do you mean by ROI of the not?
so we had projected on the basis of investment that made, we projected that quarter 8, quarter 9, we'll actually be on basis the top line.
Sure.
I'll
So-
cover
so-
up the investment.
Okay, yeah.
So
you're
that has
behind-
not happened.
Yeah,
That has not
okay.
happened because the
Right.
concept was there and we probably overestimated or under performed on the commitments. Now, what I want to know from you is if I were to go back to the same board and fund more money because I think the market exists and we have the pipeline, but what's going in a VC mind in such kind of scenario where it's just a concept that we picked up, and we've not really had that meat in the revenue to be really thinking put more 5 million or another 10 million into the concept.
All right. So let me give you just a sundry factor, right, or stat. So I've been doing venture capital since 1989, right, and I probably invested in about 70, 80 companies, right. That 60 was outdated number. And I say this, pretty candidly. I don't think I've ever funded a company among the 70 or 80 that I've funded that has absolutely met the projections and the plans they had. I don't think I have a single company that has ever met its plan. That's a relief. Right? Yeah. Now, having said that, and that's no excuse for not, working hard and not performing and so on. The point I'm making is, and again, you got to understand, the kinds of companies that I've funded, a lot of them are in the enterprise space. Some of them are in the consumer space, like Yatra and Suleika and so on, and others in the U.S. Some obviously have lost money and, gone out of business. But, when you start a company, it is very difficult to project accurately and exactly how long it will take to do something and how much money it will cost. So, which is the unknown piece, right? So you gotta, sort of understand that, and I think your board has to understand that too, right? Savvy investors with experience know that, right? They know that, listen, just because someone didn't meet the plans that they had doesn't mean that it's not a good company. It always takes longer, it takes more money, there's always unknown factors that come up, product issues come up, customer issues come up, you hire people, it takes them longer to deliver, that's just fact of life in the startup world.
Yeah.
No, you can't follow up, sorry.
Sorry.
The lady in the back, go ahead, and then I'll come to you. She's been trying to get the mic.
Hi, my name is Sharon. I'm from a company called Scaling Works, and we are into talent acquisition solutions. Been in the business for the last 4 years. Started off bootstrapping our way, and initially wanted to get into the product space, but realized that we needed to get into services to fund the R&D. Now it's been 4 years, and now we're ready to go to the VCs, but the VCs are saying, hey, you guys are more into services, why don't you stick to that? So how do you break that mold? How do you convince them that, no, you really want to be in the product space? Or do you go midway and say, I want to be in productized services?
Yeah, this is a question that comes up a lot in India especially, where you're trying to bootstrap, but to kind of feed the troops early, you run some element of services. How do you feel about those companies when they come to you?
Because VCs, there is a notion that VCs don't fund services companies as well.
Yeah, great. Give him back the mic, please.
Thank you.
Yeah. So I think there's, that's not totally accurate, right? VCs do fund service companies. When we funded Persistent, right, way back in 2005, I think is when I got first involved with Persistent. Persistent was a outsourced product development company, OPD. It was a services company, right? They did product development for other companies, not for themselves, right? So, now the other thing to keep in mind is that especially now with the advent of the cloud, right? What you're starting to see is that, and not just the advent of the cloud, but also, as more and more technology is being deployed across the world, right? So it doesn't matter whether the companies are and customers are in the US or they are in India or Japan or Europe or wherever. right? And as technology keeps getting more and more complicated, right, which it is, right, what you're finding is that managed services is becoming a big piece, right? When you really think about SaaS as a product offering, right, or a product delivery mechanism, it is, when you think about it, to a very large extent, a SaaS offering is a managed service offering, right? Elements of it, you could say not everything is a service, but in a way it is, because someone else is running that service for you, right? I have a lot of companies right now in the U.S. that are managed services companies, right? And, we have a company that's actually going to launch, I think it's next week, right? I'm not there, unfortunately. I'm traveling. I'm going to be doing press calls from here and from China for a company that's launching in Silicon Valley. This is a company, I won't tell you the name, but I'll tell you the concept. It's a security company, right? And this is a security company that is offering a solution to enterprises that have apps running in multiple clouds, right? There's lots of enterprises that have apps. They might have an app running on Amazon. They might have an app running on Dropbox somewhere. They have an app running in Azure somewhere. They got an app running in Workday because they're using a piece of Workday software, and so on and so forth. And when they have to manage security on that, right, it's a nightmare. The InfoSec department in that enterprise has to learn how to use a Workday tool, how to use an Azure tool, how to use an Amazon tool to monitor security. And this company comes in and has built a very interesting system that actually says, you know what, it's a layer of abstraction, so to speak, and it's offered as a managed service. He says, info security, you don't have to manage anything on this, just let us manage it for you, and we have built automation so that the system actually is automated and it monitors identity and a whole host of other things, authentication and everything else, automatically done, right, for an application or multiple applications running in multiple clouds for this one enterprise, right? Now, is that a product company? Is that a services company? It's a hybrid, right?
It's actually services on top of services.
Yeah,
SaaS
exactly,
on top of
yeah,
SaaS.
yeah. So I think there are demands for those companies. And one of the reasons that's happening is it's very hard for info security people or departments to find enough people in the US today, and this is true in everywhere actually, that understand enough about security, right? And they sit there and they say, listen, I can't find enough people that understand security, and so for me to find people and to train them on this system and that system and that cloud and that cloud and that cloud, and then this guy goes on vacation, what am I going to do? And I got to do it 7/24, 365. I can't do it, right? And so, and these are large companies. I'm not talking about small companies, right? That are saying this. SMBs have a bigger problem. They can never find those people, right? And so I think managed services and SaaS delivery model will continue to grow dramatically in the future.
Great.
Yeah. Hi, my name is Ramkumar.
Yes.
My name is Ramkumar. Actually, I am basically a marketing person and a product management person with about 25 years experience. So currently, I support 10-15 early stage startups in Chennai for helping them finding product market fitment. So I basically come from the business, marketing, customer side of the business. So we were talking about in the fireside chat about the one founder, two founder, the reverse side of it, you were talking about it. My question to you is, suppose if I have a more clear idea of the validation and the problem and all that, but I'm not really a techie, and I believe that the solution can always be outsourced and developed on an outsourced model. Do you still consider that as a negative point for funding? I just want to know about that.
So, some VCs say we like to lead with a tech founder, and,
Yeah.
so what's your perspective on that?
No, I think it varies. And by the way, I just wanted to make sure I didn't get across, in the earlier talk or discussion that we had. The point of that discussion wasn't so much that there need to be two founders, right? That wasn't the point. The point is the team. When we fund a company, there might be one founder, or there might be two co-founders, or three. Doesn't matter, right? The issue is you got to make sure that the initial team has got someone that understands technology, and someone that also understands marketing, right, product management, right, the team, right, so not so much the founder, but the team has to have that expertise, right. Now, very often we have funded companies where, the product concept has come more from a product management person, right, a marketing person, right, a product management person, and they've come to us and shared the idea, and they've told us, and one of the things we need to do is we need to hire a VP of engineering because we don't know how to build this. But we validated with the market that the need is there, and we will help them find a VP of engineering, or sometimes we've actually gone to companies like Persistent, which was one of our portfolio companies that does outsource product development, and said, you know what, build this product, right? We own the intellectual property rights, but here's the concept, build it, and then we'll see where it goes next.
So,
Yeah, go ahead.
luckily you have the mic.
Yeah.
So, Pramod, my name is Jazz. I represent Now Floats. We just crossed 20,000 businesses this morning, so something very nice. But somebody who's been following you for almost 15 years, in and out of India, all the things that you do. I just read the day before yesterday that 33% of the Valley startups have Indians in them. And I forget what they're the founders or what they're the
33?
33%.
Should be higher, right?
Much higher.
So there you go. So I was trying to play safe. I'm playing very safe. So let's say a third of the Valley guys doing some great stuff across the world are Indians, right? And I'm assuming most of us.
What's the question?
Most of this room is Indians, right? The question is, what do you specifically see? Is the same DNA. We're sitting in the same DNA room, hopefully.
So what's the delta?
Yeah, what's the
Silicon Valley
delta?
here?
What happens when we go there and becomes super successful?
Yeah.
And we are all sitting in front of you. There's government, there's culture, and I'm not prompting you anything, but what is that large 2-3 differences between these two ecosystems or two sorts of people?
So so let me, it's changing, but let me give you a perspective here, which I think is very important. So I think the issue becomes the following. See, when you start a company, I'm talking about product company now, not services company, product company, right? When you start a product company, what you have to do is make sure that you validate the product concept, right? Now, how is the product concept validated, right? So you can validate it, obviously talking to some experts and so on, but the real validation comes from customers, right? And so the question usually then becomes, where are the early adopters of this technology going to be, right? Now, it's changing in India, but I can tell you, 5 years ago, right, it was very different, right? 5 years ago, what would happen is that early adopters of a lot of the new technologies, right, were still sitting in the US, right? Not even so much Europe, right, in the US, right? And the issue would then become that, and this, by the way, was very true also of Israeli companies, right? We have a group, we have an office in Israel. We do we have an entity there. We do investments in Israel, right? And one of the issues with the Israeli team also is, and the Israeli companies, that when you look at the Israeli economy, it's like 2 million people, right? So when they develop, other than defense-oriented, cyber intelligence-oriented stuff, but when you look at some of the products that they develop, right, whether it be storage or whether it be networking and so on, the early adopters are all in the U.S., right? So for a long period of time, right, and even here in the U.S. and in India, what we used to do is we used to call these companies cross-border companies, right? Where we would do is we would sort of say that, okay, if a company gets started here, now I'm talking about 5 years ago, right? What you would do is you say, okay, the development team could certainly sit here, right? The CEO could even sit here, but we need to really have a couple of marketing-oriented, sales-oriented people that are very well linked into this company sitting out there because we need to get product validation and early adopter input and betas and proof of concepts done quickly, right? Now that is changing, right? In fact, I was having a very interesting discussion with one of the press people. See, what's happening is that India is slowly but surely becoming, Indian enterprises are slowly and surely becoming early adopters of technology, right? And there's a reason that's happening. In fact, if I have 2 minutes, let me just give you, if you look at the development of technology, the history of the development of technology in the US, and I do a talk on this, maybe someday if I get a chance, I'll do it here too, but let me
You will get a chance.
Okay, yeah. You go back, right? 72, I left India, went to the US. I was in grad school. 76, I get out of grad school and got a job, started traveling because I was working with customers around the US. Silicon Valley as we know it today, right, didn't really exist. Oracle didn't exist. Cisco didn't exist, right? HP in its current form didn't exist, right? Microsoft pretty much, was in its infancy, if anything, right? Yeah, okay. Technology at that time was being driven primarily by the US government, right? In fact, the integrated circuit, right, as we know it today, right, the integrated circuit was developed by Martin Marietta and Lockheed because of defense contracts, right? When they perfected the integrated circuit, prior to that it was transistors, and prior to that, if you know, it was vacuum tubes, right? When I left India in 72, our radio was a vacuum tube radio, right? Yeah. Anyway, somewhere in the 70s, right, 2 engineers sitting in Lockheed Martin in San Jose, there was no such thing as Silicon Valley, the name didn't exist back then, left Martin Marietta because they had finished perfecting the integrated circuit for defense purposes, and they got a license to commercialize it. And that's when National Semiconductor and Fairchild Semiconductor were started in San Jose, right? And that is where Silicon Valley gets the name Silicon, right? But it was all being driven at that time, by and large, by defense, right? Now, something changed in the late 70s and early 80s. A thing called inflation popped up in the US, right? Inflation during the time of Carter and Clinton and all, right? Carter, I remember, right? 20% inflation, right? Interest rates were 20%, right? And corporations were having to give big raises every year to their employees, right? And so here are corporations, large companies, I'm not talking about technology companies, food companies and all these companies sitting there giving 12, 13, 15% raises just so that their employees could have the cost of living increases. And their profits began to go like this, right? Because the cost structure is going up, right? Inflation's there, so the economy isn't growing. Profits go like this, stocks are falling, right? Markets are crashing, right? And enterprises said, oh my goodness, what are we going to do, right? And they said, we need productivity gains. We need to make our workforce more productive. And that was the advent initially of a lot of enterprises starting to use technology was being developed. That is what saw the birth of companies like Wang Computer and Digital Equipment and Data General, PDPs and DECs and so on and so forth. And Microsoft with IBM sort of with the computer and so on. And as enterprises began to use technology, right, what they're able to do was make their workforce more productive, right? So that instead of using 2 people, they could use 1, right? And that's how the rise of enterprises using technology driven by enterprises, not just the government. And that is when Cisco came out, right? Because now you had these desktop computers, right? Before you had the mainframe. Now desktop computers everywhere. You got to network them. In comes Cisco and Wellfleet and a whole bunch of other companies, right? And then you got to get productivity into your operational forces, right? Operations, right? And that is when you got a bunch of accountants sitting there. Everyone's got a general ledger, handwriting, right? And that's when financial systems come up. That's when we funded a company called PeopleSoft, right? ERP systems came out, BON and SAP and Oracle, and that's what created what we know Silicon Valley today, right? And then as computers got cheaper and cheaper, laptops, right, and Macintosh and all that stuff, right? That now, you're able to take that home with you, right? So you take your laptop with you and your children began to play with it, right? And all of a sudden, technology starts getting driven not just by enterprise, by government, still spending money, enterprises still spending money, but now consumers get involved. And that's why smartphones, right, and iPads and everything else, right? So I think India is going through that same revolution. China is going through that same revolution, right? And that is that it's not just defense spending, but enterprises now, you will see, will start to spend more on technology, right? Because they need to get productivity gains, right? Because people costs are going up, right? And so as productivity gains, as the quest for productivity gains happens, what you'll find is that, and as cost of labor keeps going up and up and up and up, right? And I'm talking about, to some extent, talented labor, right? People have to deploy more and more technology. So you'll start to see not just large enterprises, and you're already seeing that large banks here are, avid users of technology. But you'll start to see even smaller banks and SMBs starting to use the internet more effectively and starting to use technology. That happens, then early adopters of technology are sitting right here. You don't have to go to the US to figure out what the early adopters are. So, so I think India is on the verge of a product revolution, right? Okay. The service revolution has been there, but the product revolution is coming.
Yeah, and I think I'd add to that, Pramod.
And then all the consumer stuff. Yeah,
exactly.
And the entrepreneurs.
And entrepreneurs in India never had device, cloud, and experience.
That's what I'm saying. Yeah,
okay?
yeah.
And that's coming.
That's
now.
coming.
So
yeah,
now, we're using the same laptops, the same tablets as the Silicon Valley entrepreneurs did. That parity was never there even 5 years ago. Right? And so now we experience the same SaaS systems they're using.
That's right.
So now we can innovate.
But you can have all that parity, but unless the marketplace here,
yes,
right?
Absolutely.
Unless the enterprises are deploying more and more of that technology.
And I think they will.
They're starting to. Absolutely.
So one last question to end. I'm sorry, we've completely run out. I have another meeting for Pramod to head to. I'm sorry, guys, I've got more hands up than I can ask, so let me ask the last question. You've got a mic, okay. The mic wins.
I have power. Good afternoon, Pramod. My name is Rimpal Chawla. I am an ex-investment banker, recently turned a small-time investor and a self-proclaimed advisor. My question is, as an investor, do you differentiate between a product company which is registered, incorporated, based out of US versus a product company? And I'm talking about product company with IP versus a product company with an IP based out of India. I am hearing some chatter in the system that if you have IP and if you are a product company, you got to be registered in the US for a large-scale US investor to be able to take interest in your company versus you registered in Bangalore or Hyderabad or whatever.
I think that's changing. I mean, look, Mohan is sitting right behind you. He's one of my partners who runs our Bangalore office, right? We've got companies, Manthan Systems, right, doing retail analytics. The bulk of their customers are not here. The bulk of their customers are in the US, right? We got Capillary, same thing. Customers are not here. Customers in South Asia and elsewhere, right? I mean, there are customers here, but the bulk of them are outside the country, right? You look at companies like Perfint out of Chennai, right? Medical instrumentation company, selling in the US, selling in China, selling in Europe and India, right? So the scene is changing. Now, it wasn't so 5 years ago, 10 years ago, right? But today it's a very different scene.
That's exactly my thought, but I just wanted to validate that.
Thank you. Thank you all. Sorry, can't take any more questions. Now.